Buying versus selling options. When someone purchases an option, they usually do so for one of two reasons. Speculation is probably the most common reason, at least for us retail traders. If you believe a stock's price will rise in the near future, you may buy a call option to try to profit from it. Because there is no cap on how high a stock price might go, the profit potential is limitless. A call buyer profits when the option is sold for a higher price than the investor paid for it. This means that the strike is ITM at expiration for more than what you paid for it. The risk of purchasing a call option is that the stock price does not rise sufficiently, falls, or does not rise at all. This can result in a partial or complete loss of the contract's option premium investment. The good news is that you cannot lose more than the premium paid for the option when buying a call. If you believe a stock's price will fall in the near future, you may buy a put option to try to profit from this. The stock's profit potential is limited to $0 at expiration, which is very unlikely. If you can sell the put contract for a higher price than you paid for it, you profit. This is when the strike price is ITM at expiration and is higher than what you paid for it. The risk of purchasing a put option is that the stock price does not move low enough, moves up, or does not move at all. This can also result in a partial or complete loss of the contract's option premium investment. When purchasing a put option, you cannot lose more than the premium paid for the option. Hedging. I don't think many of us will use this unless we have a large amount of money at risk. If you own 100 shares of stock, you can sell a call option against them to hedge the stock's price. I do this for income. Selling calls against stock you own is better than collecting dividends in my opinion. Of course, you can collect dividends and sell calls. A covered call is one of the most fundamental option strategies. In this case, you're exchanging potentially unlimited upside profit potential for immediate cash in hand. You can sell a put option against 100 shares of stock if you are short 100 shares. This, like a covered call, allows you to reduce the cost of shorting the shares in exchange for limiting the downside profit potential to $0. The beauty of options trading lies in probabilities, and the strategies we can devise based on the price of a stock. Instead of going long or short on a stock and expecting it to move in your favor to make money, you can devise an options strategy that allows the stock price to trade within a range over a specified time frame. Because this allows us to profit whether the stock price rises, falls, or moves sideways, the probability of success rises above 50%. If XYZ stock is trading at $100, you can sell a put option contract with an 80 strike price that allows the stock to move above 80 and allows you to keep the premium at expiration. That means the stock price can fall and you can still profit, even if the best case scenario is for the stock price to rise. If XYZ stock is trading at $100, you can sell a call option contract with a strike price of $120. This allows you to keep the premium if the stock trades below $120 at the time of expiration. You can make money even if the stock moves against your position, up to the $120 strike. You can even combine these two ideas to collect more premium and establish a trading range of 80 to 120. That would be called an iron condor, which is simply two credit spreads, one on each end. The trade-off here is that you would take risk on both sides of the market in exchange for the possibility of collecting more premium and having a wide range for the stock price to move. What makes this especially enticing is that the farther away from the stock price you move your strikes, the higher your probability of success. That's how you manage your risk in options trading. Just remember, less risk equals less premium. This covers a few very basic trade opportunities, but there are many more advanced strategies out there. Thanks for watching. Please leave a comment or question below. Click like and